Welcome to New Home Insights, the podcast from John Burns Research Consulting. I'm your host, Dean Worley. If you want to follow market trends, demographics, capital, new ideas, and endeavors that touch on housing, we're going to try to make sense of that every couple of weeks. Let's go. Hi, everyone. This is Dean Worley with the New Home Insights podcast. Today, we're going to go all in on economics. We have Neil Dutta from the Renaissance Macro Research, where he heads up economic and policy modeling and trends and forecasting. He also contributes to Bloomberg and to Business Insider. Am I right?
That's right.
Honestly, it's not an exaggeration to say that everybody in any economic sector that matters is listening to what Neil has to say. So we're not going to have a typical housing-centered episode here. It is really going to be economic-centered, the economy, jobs, inflation, tariffs, mortgage rates. But as you can see, that stuff really hits on housing very directly. So I hope this is interesting to you folks. One last thing before we get started, Neil, I want to stress, because this is economics, things change in an eyelash. We are recording this on June 12th. So if something crazy happened on June 13th, please don't blame Neil. And in fact, June 13th is Friday the 13th, so all bets are off. Neil, how you doing this morning?
I'm good, Dean. Thanks for having me on.
Let's start with how you usually do. Just kind of a little bit about your background and then what you do at Renaissance.
So I'm what I call a business economist. I mean, what I basically try to do is, there's lots of data points that come out every week, every day, market moving things like people know, like non-farm payrolls, things that are somewhat less widely followed. And my job is basically to formulate, a thought process and an outlook for people to kind of interpret those data points to make them help more informed sort of investment decisions. So, I'm not like a classically trained economist. I mean, we call ourselves applied, maybe business economists, but that's what I've been doing for a long time now. I mean, since, really since 2005, 2006. I started at Merrill Lynch, and I worked there for 7 or 8 years. And then I've been at RenMac since the early days of its founding, which was, for me, starting in 2012.
At RenMac, who are your clients? Are these just major investors, pension funds, things like that, or just is it a pretty diverse group?
It could be pension funds. It's always important to kind of talk in the time horizon of your clients. And some clients live very much in the short run. Other people have more, sort of extended kind of time horizons. But, our client base, runs the gamut. It could be long, short equity. It could be multi-asset managers. It could be CIOs at like wealth advisories. It could be pension funds.
Yeah.
And we have, clients all over the world. I mean, predominantly in the US, but Canada and Europe as well.
Yeah, and I've seen you speak a couple of times, and what I've liked is that you're not afraid to take a stand and say, here's what I think, here's why. Let's see what happens. I love that. You're not mealy-mouthed. Like, I'm not going to say like most economists. I would never make that kind of generalization like I just did, but I mean that. So let's start with that. Let's start with the big picture: economics, jobs, inflation. Let's start with the biggest picture. How is GDP, just sheer economic growth and change, holding up right now in the U.S. economy?
Well, it's really tough to get a very clean picture on GDP because so much of it is determined or skewed by what's going on with tariffs, right? So if the president threatens a tariff, then people will potentially pull forward their spending, right? And businesses may pull forward imports, and that has consequences on GDP, right? So you get a big increase in imports. Mechanically, that'll make GDP growth look like not as strong, right? So by contrast, if President Trump says, well, we're going to remove tariffs, well, then maybe you get a scenario where consumers delay their purchases because they're waiting to see tariffs come down, and they want to wait for that before they go out and buy. So it's really difficult to get a good signal from GDP at the moment because of all this sort of, the behavior shifting because of tariff noise. And I think that's why it probably makes a lot more sense to focus on things that are much harder to move around, like people. And that's why if you look at the labor markets, I think
Yeah.
that probably gives you a much sort of cleaner read on the direction of the economy at the moment.
That's actually exactly my next question I was going to ask is what is the better metric? Is it job change?
Yeah, I think so. I mean, I think, employment is important. Employment is also like more of like an irreversible decision, right? Like if you're a business and you just hire someone, it's really hard to fire them right away, right?
Yeah.
Like, so you kind of want to be sure about things before you hire them, which makes them less, which makes like hiring and investment decisions somewhat less prone to, tariff events.
Hmm.
Right. So I think that's why I'm focused on the labor markets. Yeah. And the labor markets are slowing.
So, okay, I was just going to ask you. So the most recent monthly payroll read was, I think, 139,000 job change. And I noticed because I see a lot of news feeds, and honestly, headlines range from tepid job growth to solid job growth to this was a great month. What are you looking for in job change? And follow up on what you just said. Where do you see job change going?
Well, I think to me, that's a reflection of even if the data is the same, if you put two economists in a room, you're lucky to get three opinions, right? So I think that's what that demonstrates. Look, I mean, I think a lot of that narrative has to do with where do you think the break even level on employment is, meaning what is the
Yeah.
rate of jobs growth that you need to hold the unemployment rate steady, right? Because there's some evidence that the break even rate has come down
Mhm.
because the labor force is not rising as rapidly as it once was. Maybe that has to do with immigration and so forth. And so the theory is that, well, even if jobs growth is slowing, that's okay because we don't need as much jobs growth to hold the unemployment rate steady. So that's one view. I don't share that view. I mean, I
Okay.
think, to me, that's kind of tempting fate. And also, there are cyclical, we could be misdiagnosing this as well, right? I mean, there are cyclical reasons for the labor force to slow down. Um, Also, right? I mean, if, for example, if you are very negative on your employment prospects, maybe you don't even bother looking for work. In that case, your participation rate would come down. And that would also be a sign that, well, hey, I mean, labor force growth is slowing, but it's not necessarily a good thing. It's not a structural or supply side consideration. It's a cyclical development. So, and I would say like demand for work has been coming down, right? Like job openings are coming down. And even the level of unemployment has been going up. I mean, we got a data point this morning on continuing jobless claims. I mean, that basically broke out to a cycle high in the latest week, and that wouldn't be happening if unemployment were holding steady. Um, and you'd also expect to see employers telling you that it's getting harder to find people, right? The labor force is growing too small, but nobody's really saying that,
Yeah.
right? I mean, if
Yeah.
anything, they're saying it's getting easier to find workers,
Yeah.
even in industries where they've been worried about immigration, right? So
And haven't they been emboldened to sort of forced to back to office in a way they haven't been a year ago or more?
yeah, right. So I think that to me, there's more evidence that demand is like really the predominant concern right now in the labor market. And, I just think that people are tempting fate. The more they are willing to kind of give ammunition to these arguments about labor supply and, the slowdown is okay because it's basically
Yeah.
it's a labor supply story. It's not necessarily a demand story. The more people do that, the more risks I think build in the economy.
Is there a Neil, is there a reason we have not seen more of an impact from what we in the headlines seem to be like layoffs in the federal government, which is a ton of people? It doesn't seem like that we've seen that in top line numbers. Is that just a technical reason or what's happening there?
Well, you've seen some impact. In fact, I mean,
Yeah.
federal government work has been declining over the last several months.
Yeah.
So there has been some impact. I mean, it's
Okay.
unusual. I mean, federal government workers tend to be going up.
Yeah.
So it's so the fact that it's coming down a little bit is
Okay.
interesting. So that probably reflects some of the Doge related cuts. But we also know that effort's probably mostly behind us at the moment.
Okay.
So I don't think I think the bigger story, frankly, I mean, I know Doge got all the headlines, but I think the state and local government piece is actually much more important because that's a much bigger employment story, right? State and local governments. And also, a lot of these state and local governments, they basically assume that their COVID relief money was permanent. And it wasn't. And now
Yeah.
they have to adjust their budgets in response. And that means, they have to cut openings, fire people outright. And
Yeah.
so you're starting to see more evidence of that.
Okay. Let's talk about inflation. That's a huge issue. I think it ticked up slightly to something like the CPI was 2.4%. I wanted to talk to you before we talk about where you think inflation is going. Can you just briefly touch on, there's a couple of different measures of inflation that the Fed and other folks look at. The CPI, and I'm drawing a blank on the other one, which I think the Fed looks, it's the core index, right? Can you just briefly, at a high level, explain what the difference is between those two? Because I think there's a lot of not understanding out there.
Sure. So there's the consumer price index, which is, the CPI. Everybody knows about
Mhm.
CPI. It's what they index your Social Security benefits to and things like that. And then there's the Fed's preferred measure, which is the personal consumption expenditures deflator, PCE price index. In business economics, we have, sort of different measures that look at the same concept. And in this case, inflation. But the surveys are different in terms of scope, in terms of weight. For example, one of the reasons why the Fed looks at PCE is because it covers a wider net of things, right? I mean, so that's important. The CPI, for example, with respect to healthcare, as an example, it only looks at out-of-pocket expenses, right? By contrast, PCE looks at payments made on behalf of the individual, right? Like, so Medicaid, Medicare, third-party payments. It looks at different components differently. So, for example, the airline fares, airline fares and CPI. That's looking at specific routes that are flown, and they're kind of telling you what the price is on those specific routes. By contrast, the PCE index is looking at, essentially like revenue passenger miles, which is like more of the industry
Okay.
standard for pricing. So, the same thing with education, right? I mean, CPI is looking at out-of-pocket expenses for education, and PCE will be looking at, payments made on behalf of people for
Yeah.
education. So it's, um, that's why the Fed looks at PCE, because it casts a much wider net, and that creates differences in weight, right? So
Yeah.
because PCE is looking at more things, stuff like shelter
Yeah.
way has less importance in PCE than it does in CPI.
Yeah. And isn't that so? My next question is kind of, let me ask you about where you think inflation is going in just one second. My other question is, how lagging is both of these measures, CPI and CPE, in terms of really gauging immediate inflation? My understanding is the CPI, for instance, the housing part of that is months lagging. Is there a concern that we're capturing inflation a while ago with either one of these measures?
Well, it's lagging. It's lagging new leases. It's not. I mean, so that I think that's what's important, right? So there's a way like industry people talk about rents, right? Like,
Mhm.
but the CPI is looking at all tenant rents, right? Basically, it's not just looking at new leases, which is when people talk about what rental growth is doing. They're looking at
Yeah.
new leases and
Yeah.
how those are turning over, right? They're not looking at all leases. And the CPI looks at all leases, which is one of the reasons why it lags market-based measures of rents.
That's probably actually a better measure, right? Because it means that you're capturing the market a little more accurately, because existing leases are almost always lower than new leases like to like.
Yeah, I mean, look, Ben Bernanke has said inflation is a lagging indicator,
Okay.
right? Like, so it's known widely, like, how these indicators work. Um, and it is what it is. I mean, you're just as good as the data that you use,
Yeah.
and this is the data we use.
Do you think there's some lagging inflation that we're not picking up yet, given the expectation of the
No, I mean,
impact
I
of
think,
tariffs?
but to me, the big story is that people are still underestimating the extent to which shelter inflation will keep coming down,
Okay.
right? And
Oh,
so that's not. I mean, like, service sector inflation is going to be pressured because compensation growth is slowing, and I think that's important. Right. So ultimately, I think that to me is the big story for inflation, right? Is that ultimately it comes down to a budget constraint, right? I mean,
yeah.
if a household can't negotiate their wages up to where they think inflation might be, guess what? Inflation is not going to get that high.
Yeah. Okay. I mean, it sounds like you're projecting inflation to continue to moderate. Is that fair?
I mean, I think some things will go up in price. I think some things will come down in price. Yeah.
That's now I advertise you as taking these bold stances. That
But
was the
I'll put it to you
opposite of
this
a
way.
bold
I
stance.
think inflation will not be as much of a problem as the consensus expects it to be.
Okay. Okay. How about the other big question, maybe even the bigger question, is the talk of the R word, recession. Are we heading toward some kind of a recession? And tell me how sharp or how moderate, how long it's going to be. But are we heading towards a recession this year or next year?
I mean, um, I think so. I mean, I'm kind of in the minority, to be honest, with that. But I do think that there's just a lot of like, um, the recession call is very much like it's a price leads narrative call, right? Like, why do people no longer expect recession, even though they
Mm,
did like 6 weeks ago? Because the stock market's higher today than it was
yeah.
6 weeks ago. I mean, that's all it really is. But when I think about recession, I think about the risks to the economy, right? And what do I see? I see claims going, like continuing jobless claims going up. I see housing inventories going up. I see home prices coming down. I see very sluggish growth in business investment, particularly outside of AI.
Mm,
So I don't know. I mean, it may not be a full blown recession, but it's
mhm.
not good.
Yeah.
And it's also foolish to think that it stabilizes on its own, right? So I think that's what's important. Ultimately, stabilizing the economy is going to require some kind of a policy response from the Fed.
Let me ask you a typical question. It's like sort of opposite ends of the recession chance. That is to say, what is kind of the best case or the best metric you're looking at to say we're going to avoid a recession, and the opposite? What is kind of the worst case recession scenario that we might face?
Well, the worst case recession scenario is very easy. It's the nonlinear increase in unemployment, right? Like, so basically, you have let the unemployment genie out of the bottle, you can't
Mm,
put it back in. And that snowball is gathering steam downhill, and you have the negative feedback loop where unemployment means declines in consumption, which implies more declines in more increases in unemployment, right? So that negative feedback loop, that would be to me like the biggest risk, right? It's like a more rapid increase in unemployment. Um, and what would get me more optimistic if you see stronger jobs growth, maybe Trump backs off the tariffs, maybe you don't
yeah.
get. I mean, if you get uh, less inflation than people think, that could maybe get the Fed off the sidelines sooner. I mean, that's something to think about. So, these are the things I'd be keeping an eye on.
Is there one policy change that would scare you the most?
I mean, we'll see. I mean, if he goes back to these like reciprocal, I mean, if reciprocal tariff rates that you had, right, and he says that we're going to put those back on, I mean, that would be a big risk. Sure. I mean, I guess my issue right now is one of the questions I'm trying to ask myself and come up with a good answer for is it the tariffs themselves that are bad, or is it the way they're doing it that's bad?
Yeah.
And which one is worse?
Okay.
Right? Because, if Trump came out and just said, you know what, we're going to do a universal 10% baseline tariff and that's it. And he basically sell it to the country as like, this is like the price of entry into our market. It's essentially a very inefficient consumption tax, uh, but he could sell it to the public that way, right? Like this
Yeah.
is like the
Oh,
price of entry to the U.S. market.
yeah. And he kind of has. In some of
I
his.
mean, he has now, but he's
Yeah.
done it in such a way that it's
Yeah.
like people don't know what's coming next, right? And so I do wonder a little bit about that. Like, had he just done the baseline tariff
Yeah.
and kind of negotiated from there, as opposed to starting at a ceiling and working back, like, would he have saved himself a lot of the anxiety that has entered into the market?
Let's transition to tariffs then. So right now, outline kind of where we stand with tariffs, the 10% baseline, and specifically with China.
I mean, I can just tell you that the effective tariff rate is around 15%. I mean, there's tariffs on steel and aluminum. There's a
Oh,
10% baseline tariff. There's there's specific tariffs against China on for fentanyl reasons. And so there's a whole host of tariffs that have been put on at the moment. And there's additional ones coming for national security reason. Like these are the Section 232 tariffs. Things like
yeah.
pharmaceuticals and medical equipment and
Is that part of what you mean? I mean, when you start opening the tariff genie, you do make folks worried about what does come next. Like you said, pharmaceuticals might be
Well, I
hit.
mean, look, the Trump and his Treasury Secretary have both said uns- strategic uncertainty.
Mm,
They've said that
yeah.
strategic uncertainty. So uncertainty is a feature of these negotiations and a feature of their strategy behind this policy. So if it's confusing, it's by design.
Yes. In a national security framework, strategic uncertainty is good. You're not signaling your quote unquote enemy. In terms of uncertainty, though, for your domestic consumer, not so much.
Yeah, I mean, businesses uncertainty is the enemy of business, right?
Yeah.
I mean, and so that's kind of where we are.
Are we have we seen much of an impact yet? I mean, like I said, it's not. It doesn't seem like it's being picked up in inflation. What do you see the impact so far from tariffs?
Well, so far, I think the most obvious is basically in business investment,
Okay.
right? Like investment intentions fell rapidly
Yeah.
in May. They've recovered somewhat since, but they generally fell right after Liberation Day. And so that to me is notable.
What do you see then as the long term impact if we have tariffs for at least the next 3.5 years? What does that do to inflation? What does that do to the economy, to the deficit?
I mean, I think on net it looks contractionary, but
Yeah.
that's me. I'm probably in the minority when I look at everything. But um, I think it's
Contractionary to the economy and economic growth.
well, yes,
Okay.
and it's also like it's probably I don't know that I mean look you're bringing in a lot of money, and I think relative to where the market was after Trump got elected, like on net is fiscal policy expanding as much as people thought? Like I don't know that that's true. Um, So yeah, I mean, I think it's large. I mean, to me, like the issue is it's the nominal anchor, right?
Okay.
Like tariffs will not really change the overall trajectory of inflation because the nominal anchor is not changing. So if
Yeah.
tariffs are going up and people have to spend more on those goods that are going up in price,
Yeah.
they'll have less left over. Ultimately, it comes down to the where nominal income is, and nominal
Yeah.
income is still slowing.
What do you think the impact would be if the administration did sort of cave in and call off tariffs? Would that be an economic blossoming, or do we still have fundamental reasons to think the economy is still going to be
I
a
mean,
little
if they
sluggish?
caved completely on tariffs, I mean, stocks would go up and longer term interest rates would probably come down.
Okay. Is there a case though then that the economic fundamentals specific to housing? I'm going to ask you a housing specific question here as best you can. If that happened, do you see housing snapping back? Has been a pretty darn sluggish spring selling season. Most people attribute that to
I
the
mean, it's going
tariff,
to
at least
take time. I
psychology.
think the reason is because wage growth is slower, right?
Okay.
Like, so if you get a drop in mortgage rates, is that going to be enough all else equal? Because wage growth is a lot slower now than it was a couple of years ago, right? Like, so the math would still be pretty challenging. I'm not sure. I mean, I think you basically need to see a much more aggressive rate cutting cycle
Yeah.
and certainly way more aggressive than what's priced into the market right now.
So those classic things like job growth, wage growth. Your take specific to housing is that those are still, let's say problematic.
Well, I don't think that I don't think two rate cuts this year is going to do anything to
Okay.
meaningfully alter that. How's that?
Who's you is going to pay, quote unquote, for the tariffs? Because I saw something not long ago that said, "Oh, we think the ultimate impact will be sort of the host country will eat some of it. The American companies doing the importing will eat some of that added tariff costs, and then the consumer is going to eat the rest." I mean, does that sound right to you?
Yeah, there's slippage along the supply chain, right? Like, so
Hmm.
consumers will eat some of it. It depends. I mean, it remains to be seen how much of it they'll be eating, but they're certainly going to eat. I mean, I think one way, maybe a third, a third, a third. I mean, that's
Hmm.
one way of looking at it. A third
Yeah,
by the exporter, a third by the importer, a third by the consumer.
yeah. What does that do to inflation? I mean, that would not have a huge. I mean, I imagine that would have an upward impact on
Yeah,
inflation,
no,
but not
it'll push
massive.
inflation up. The question is whether we get up to these like high 3% range, which is where the consensus is right now. I'm not so sure we get there because I also think that shelter inflation slowing down, and that's important too.
So the administration has sold this to the degree they have, that is sort of reshoring jobs into the U.S. We can build iPhones here. Would that be inflationary because we cost a lot
It
more
would
than
be,
they do?
but it's not enough to. The tariffs aren't strong enough, high enough to
Okay.
reshore things. That's the issue, right?
Yeah.
You would need to have a much higher tariff rate to have Apple start making the iPhones here.
Do you see any of that happening? I've seen estimates that these kinds of things take years and billions of dollars that
Well,
you
also,
can't.
like, there's a lot of uncertainty around whether these tariffs stick around or not.
Yeah,
So if you're a business, like, why would you commit?
yeah. Okay, so that's gosh, I'm looking for something somewhat positive. I mean, do you think tariffs?
Well, AI is the positive story
Okay,
right now, Dean.
has that started to play out a little bit in terms of the expenditures on AI, or at least to start
Oh,
to
it's a
trend
huge
downward?
macro issue. I mean, it added almost a percentage point to growth
Did it
in the
really? Okay.
first quarter. The issue is that you can't run an economy just on AI
Yeah.
capex.
Before I hit over to consumer confidence, I want to ask you about, let me ask you about mortgage rates in just a second. Let me talk about consumer confidence because that did take a hit with Liberation Day. There was a bit of a comeback most recently, I believe, with the conference board. Where do you see consumer confidence going next few months or so?
Well, consumer confidence, I think you can basically boil it down to three things, right? It's stock prices, gas prices, and what your labor market situation is. Okay.
Okay.
Maybe house prices too.
Egg
Um,
prices, you forgot eggs.
yeah. I think it's probably flat to slightly down. I mean,
Okay.
labor markets are getting worse. Stock prices are buoyant, so that's helpful. But generally speaking, I think the labor market's getting worse is important. So I mean, consumer confidence has been depressed, but I don't see it really changing that way.
Okay.
It's
Okay.
basically stuck at a depressed level.
Do you think that measure, though, has been more clouded than it used to be by partisanship and ideology? That is to say, when your guy's in office, you're more likely to be confident, even if you shouldn't be, and vice versa.
I mean, it depends on the measure. Like, I think definitely some of these measures are skewed by politics, but as a business economist, I definitely think that using surveys helps refine your forecast. And
For sure.
there's still useful information there, even if it is skewed by partisanship. Like, as an
Yeah.
example, the conference board does a component on, like, the labor differential, and they're
Yeah.
asking people, like, are jobs hard to get or are they plentiful? That still lines up reasonably well with measures like the unemployment rate. So it's not
Yeah.
to me immediately clear that we should just discount the entire thing because there are Democrats in it or Republicans in it or anything like that.
As a former political scientist, I think I think that measure has become pretty tainted by politics in a way it wasn't, 10 years ago and before. You can see the way it shifts from administration to administration. But I agree with you. It's better than nothing. We definitely should be using surveys for what we forecast for sure. Let's talk about mortgage rates. Do you see the Fed cutting interest rates? I think you mentioned a couple of times this year. Do you see that still happening?
I do. I mean, everything I look at says that they should be cutting. I mean, the labor markets are getting worse. If arguably the labor markets have been getting worse before the inflation numbers have, right? So we've had several months in a row now better than expected inflation and several weeks of higher than expected continuing claims.
Okay.
So,
Yeah.
yeah, I think they'll be cutting this year.
Would they already have been cutting if we didn't have tariffs?
Yeah, for
Yeah.
sure. That's
Okay.
not a debate. They'd be signaling something different than what they're doing right now. If there were no
They always try to balance the growing, unemployment and inflation, growing the economy. They always seem to err on the side of keeping inflation tamed. Are they going to just, if the labor market does continue to erode, do you think is there a chance of them getting pretty aggressive with cuts down, later this year?
Yeah, because of they should get aggressive with cuts because if the labor markets are cracking, it basically it takes care of the inflation story.
Yeah.
You don't get inflation if the labor markets are falling out a bit. Like, it just
Yeah.
doesn't happen.
Okay.
That's kind of where I'm at. I think that's where the Fed is too.
Okay.
But it's sort of like they're conditioning themselves to be behind the curve, right? Like, they want to see it in the data before they're willing to act because they're uncertain about what tariffs might do to inflation. And because we're coming off of a period of high inflation and problems with supply chains, they don't want to see that again. And
Okay.
so that means that they need to be very convinced of how weak the labor market is before they're willing to act. And that creates problems for the economy because the labor markets are already weak. So you're asking to see even more evidence of that weakness before right? Like, if you should be cutting now and you're not, that just means you may have to cut more later once you start.
Specific to mortgage rates, because again, that hits on housing most directly for our audience, is just your best guess right now. Our national rate is something high 6%. What do you think happens with specific to mortgage rates, housing mortgage rates, the rest of this year? Do you see those ticking downward?
They should be coming down towards the end of the year because the economy is going to be weaker and the Fed will be cutting.
Yeah, but it creates that
I mean, the issue though is that necessarily a good situation, right?
Exactly.
Because I think it will be for the people that have jobs, right? So,
Yeah.
but so it should be still helpful for the housing market. But yeah, I mean, there's going to be some cost associated with that because it's a reflection of a worse economic picture, which means a weaker labor market environment.
Yeah. And so it's going to be from market to market, from metropolitan area to metropolitan area. It's going to depend if you're undersupplied and you're focusing on high wage earners, you're probably doing a little better with that lower mortgage rate environment. If you focus on a lot of entry level folks who are worried about losing their job or have lost their job, it might be a little more negatively impactful. Does that sound fair to you?
Yeah, absolutely. I
Okay.
mean, well, also keep in mind that those people that are newly entering the workforce are also their labor situation is much more precarious.
Yeah. Yeah. Let's talk a little bit about supply chain. Is there any disruption that you can discern so far with global supply chain from tariffs and trade regime that's now in place?
You've seen some. You've seen some. When I look at like things like delivery times and stuff measures like that. I mean, you've seen some slippage, but I mean, it's nothing like COVID yet.
Okay.
Okay. And the thing is that why would supply chains get totally upended? I mean,
Yeah.
we've backed off some of the tariffs.
Okay.
Um, you know, there was a trade embargo in place with China. Now there no longer is. So it's, these things take time. But if you look at what's happened, like with supplier delivery times, I mean, they've gotten a little bit longer, but it's not anything like what happened with COVID.
It's not the pandemic like where you can't get something for months and it just really disrupts and housing. It was incredibly frustrating. It was like the window latch won't be in for 3 months, so we can't complete that house. Those kinds of things. You don't see those kinds of weird hiccups
No,
repeating. Okay.
no, not yet.
Do you have a labor disruption from immigration policies? Do you see that so far? Housing folks tell us that's not a big factor.
Yeah, I mean, I think. Look, I mean, I tend to view that demand of labor is what's really slowing down. So I don't know that immigration is having the real effect that everyone's. That might matter later when the economy starts to recover, but that's not the case at the moment. I don't think.
Yeah, hiring those folks back to the degree you have deported folks that would be in the labor pool, getting those folks to come back might be more difficult than last time. So let's end with just something as specific as you can be on the housing market for two-parter. Kind of one is you hear a lot of the housing sector is this much of the economy, this level. How big is the housing sector relative to the national economy as a whole in your measure, in your mind?
Well, I think residential investments like maybe 5% of GDP. It's not particularly high. Now I know, like, but this is true of every industry, right, Dean? Like, it's like the manufacturing sector thinks it's like, oh, we are X percentage points of GDP and we support 50% of the economy. I mean, it's every industry tries to overinflate their own self-worth,
Yeah.
I guess.
But there is indirect for housing
Of
specifically.
course,
There's
they can correct things with everything.
yeah,
But right, I mean, yeah, you don't. I mean, car manufacturing supports, retail sales, right? Like because you need people to sell the cars, and
yeah,
so it's like there's a
yeah.
lot of that. Same thing with housing too.
Okay.
No, look, I think housing is important. I think it's an important part of the U.S. economy. I would just say that to me, the big issue right now in housing is that inventories are rising in the places the home builders make houses, and that to me is a huge problem.
Yeah. And it has been for longer than people maybe think as well, and it's continuing to rise. We're definitely seeing supply grow, and it's having impacts on those hot Sunbelt markets for sure. What is your general take then? Just we'll end with this. Just generally, I know you're not a specific housing economist, but just generally, how do you see the housing market going, say the next year or so?
I think the new single family market's going to be under more pressure. Right? I mean, I don't think I think builders are going to be focused more on selling the homes they've already made as opposed to breaking ground on new homes.
Yeah, we've seen some incipient lift in rental. Do you see rental rates continue to come up a little bit?
I mean, we haven't really seen that in our data.
Okay.
If I look at median asking rents, they're still quite sluggish. So we haven't seen that, which makes sense because the labor markets are cooler and home prices have come down.
Yeah, yeah. So nothing positive for the folks at home with the housing other than get
Well,
rid of
there's
the
a
tariffs.
demographic tailwind that
Yeah,
people have talked about, so that's helpful. But I think, think about this scenario for new housing, right? I mean, if you get a decline in interest rates, let's say, that probably puts upward pressure on resale inventories because now a lot of sellers will feel more comfortable about selling. And they'll also feel better about moving into another house because rates have come down. So they won't feel as bad about moving into a new mortgage product, right?
Yeah.
But if there's more inventory in the resale market, that'll be a challenge for home builders because now they have more competition, right? Home builders did really well when rates were rising.
Yeah.
So why should we assume they're going to do really well if rates go down?
And ironically, though, the one and the biggest advantage they still have right now is buying the rate down. Even if the rate comes down a little bit, it's still going to be a lot higher than those 3% golden handcuff folks. So they still have the advantage of being able to get their buyers down to a much more favorable rate.
I mean, home builders have a lot. I mean, home builders are in the business of selling homes. So they're going to try to pull every lever to do that. But at the same time, that also means you're willing to sacrifice more on your margin in order to do so.
Yeah. And we've seen that. But, it's the housing world has become so much more impacted by sales velocity as well that they're willing to do that. So, Neil, great having you on. I appreciate all your insight. It's not, as you can tell, I was fishing for positivity as desperately as I can. But, for what it's worth, and tell me if you completely disagree, I think, you do see some folks out there who have this sort of sky is falling kind of mentality. And that doesn't seem like that's the most likely outcome. Is that fair?
No, I mean, I think it's really hard to pencil in like that kind of a scenario. Like I'm more cautious than the consensus, but it's really hard to pencil that kind of a scenario in because the Fed has a lot of ammunition to deal with bad outcomes, right? They can cut rates a lot. And so that's helpful.
Okay. Well, I'm hopefully they use that ammunition judiciously and a lot. Neil, thank you so much for coming on and joining us. Right.
I appreciate it.
This is Dean Worley for the New Home Insights podcast. Thanks for listening, and we'll see you again in a couple of weeks. Since you forgot to hit the stop button, I'm going to take a second to tell you about our weekly Building Market Intelligence newsletter. Over 40,000 smart folks get these timely takes on the housing market in their inbox every week, and you can too by heading to jbreg.com/subscribe and signing up.